Good morning, everyone, and welcome to this episode of Derek Invests. I'm your host, Derek Miller. We are waiting today to hear Powell speak about interest rates and what interest rates are going to do, so on and so forth. Now, we have gone over the 20-year Treasury via the ETF TLT a couple of times in the last few weeks. We have a lot of insight there as to what should be coming. So I thought what would be interesting for today, because I'm always trying to find interesting subjects for us to take a look at when we're looking at different stocks and different positions, would be the top 10 companies most affected by interest rates. And so I went through, and shockingly, there was a couple that there were a couple in there that surprised me. One mainly. Now the financials did not surprise me. Okay, so we have Bank of America, Wells Fargo, Goldman Sachs, J.P. Morgan. Then we have Lennar, Home Depot, D.R. Horton, American Express, and AT&T. So those are the top 10 companies affected by interest rates at the moment. So AT&T is carrying so much debt that they are among the top 10 companies affected by interest rates. I had no idea. So I thought that was interesting. When I read that, I thought, wow, that's amazing that they're carrying that much debt. And then Home Depot probably surprised me as well. I know interest rates would affect them, but Home Depot was interesting to me. American Express, they're saying the reason behind that being that consumers are less interested in debt. I didn't know they were the number one carrier. They must be of consumer debt when it comes to credit to some extent. To make it into the top 10 with Goldman Sachs, Bank of America, J.P. Morgan. The financials, those are easy. We know exactly why they are the way they are. So I thought we would do today is we would go through and take a look at these and see if they gave us a little insight into what might be coming. Also, having had an interesting conversation yesterday, new student starting the VIP mentorship next week, which will be a lot of fun. If you're not familiar with what the VIP mentorship is, it's an 8-week course. We get together twice a week for education. One will be in the, depending on what coast you're on, either early afternoon and then in the evening, or it'll be midday and late afternoon, depending on what coast you're on. It's an 8-week course. We'll do two pieces of education. We'll get together live twice a week. We do a Q&A once a week. And you'll receive the recordings of that. I had an interesting call yesterday about it. And the reason I found it so interesting is that the individual that was interested kept talking about following me and just mimicking my portfolio, and he'll do what I do. And I have to tell you all, and you all have got to know this, anyone who's telling you to mimic their portfolio, or you're going to pay for a service to do what they're doing or exactly what they're doing, or if that's your plan, that's not going to work. You must understand this. That's not going to work. All right. If you don't have the knowledge, if you don't understand, if you don't have the confidence backed by knowledge that what you're doing is correct, you will make the emotional mistakes that every single investor makes every single day, every single time those emotions are invoked in the market. That was emotions, 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 emotions. I'm saying that because that's the truth. All right. This is an educational course that I provide. When I put out my videos every day, like the video I'm going to do right, like we're doing right now, and what I'm going to walk you through, the intention is to teach you. But let me tell you something. This is a very personal thing. I only allow 5 people into my mentorship for a reason, because if I allow more than that, you won't get enough of personal attention for any of the information that I put out on a daily basis to matter. You have to cover the 3 pillars of any good investment guideline, rule book, whatever you want to call it. And it's personal for you, built by you, based on the knowledge that you've attained. That's risk management, cash management, and investment management. Okay. That's what you learn through my course. How to identify trend changes, tops and bottoms, how to know when you're in a bull market, how to know when the market's signaling that the Titanic is sinking, or how to know that it's just a correction, no big deal. And a small correction from a large correction. So what stock is a falling knife? Meaning, don't try to buy that thing. I don't care how far it falls. Or which stock is, oh, that is an amazing value right there. These are the things you learn in my mentorship. If you're interested, email me at dmiller@prometheainvesting.com for details. I also tell everyone, and I have two brand new students that are doing one-on-ones with me right now. And you can visit prometheainvesting.com and fill out the contact form. Tell me you're interested in one-on-ones, and we can discuss that. Or you can just shoot me an email at dmiller@prometheainvesting.com. But by all means, everybody, this is not I don't do anything. The design is not, well, I can just mimic what he's doing. I'll just follow what he's doing. That's not the design, and that won't work. So if someone's telling you that you're going to do that with them, or they're going to give you the best stock picks, none of that's going to work. You have no baseline knowledge. You have no foundation. You don't know who you are as a trader. You don't know the rules that you want to follow, and this stuff's important. Even I don't care if you've been trading for 15 years. If you find yourself, hey, I make a lot of money when it's going up, you and everyone makes a lot of money when it's going up. You're buying calls, you're buying futures, whatever you're doing. But then when it reverses, not only do you give back what you made, you usually give back a little more, whether you want to admit that or not. If that's you, I have a solution for you. Let's change that. Let's improve your situation. All right. So in any case, listen, the other thing I want to mention was this particular individual had made some good money recently. He'd given all the profits back, and he was down another 50,000. He said, "If I just got back to where I was, I'd be ready to sign up. I'd be ready to go." Look, I can't fix the mistakes you've made. You've made them. What I can tell you is this: if you found yourself in a position where you've given back your profits and then some, or just given back your profits, or not even giving back all of your profits, but a lot of them, you need to make a change. No one can fix what you did. You did what you did. But you need to make a change. The time is now to make that change. You don't wait. You don't say, oh, once I get it back, That's the age-old story of anybody who's ever lost their account will tell you exactly what it is, right? That's what it is right there. As soon as I get this back, once I'm even again, well, I was up a little bit. Once I'm up that again, I'm out. It's the same story over and over in your head. It's time to change that story, everybody. If that's you, and a lot of you out there, you know that that's you, because there's a lot of trend followers out there that just get eaten up every single time a trend turns, and they think there's no way to identify it. So they keep extending their Fibonacci, right? And they keep extending their moving averages. These are lagging indicators. They're never going to indicate when there's an actual trend change. I can show you how to do that. Anyway, I'm going on and on and on. Let's look at some of this stuff. All right, so one-on-ones and the mentorship. I'm only taking 2 more students into the mentorship next week, and I will only take on 3 more one-on-one coaching students. If that interests you, I would jump on it before it is gone, because that really is all I accept. Okay, let's hide that. Let's share my screen with you, and let's start. We're going to look at AT&T first, because I was really surprised that was one of the top 10. Shocked that was one of the top 10. If you see the Dow up here, guys, that's because those are the futures that I like to trade. Let's go up to AT&T. Boom, boom. The Dow micros are only $5 a basis point, which, if you're new to futures trading, I hope you're a master in the stock market if you're over there trading futures. But if you're not a master in the stock market, one, you shouldn't be in futures. But if you are, at least the Dow micros are only $5 a contract. Okay. AT&T. Wow. I have to be honest with you. I hadn't looked at this company. Look at that. It is below 2009. Poor AT&T. Let's zoom in and see if there's anything worth looking at here. Wow. Some of these companies I just don't look at because there's nothing to look at. I had no idea AT&T was one of them. I really did not. I guess they're carrying a ton of debt. Now, what would have been interesting, had we looked at this sooner, would have been the fact that this gap set up here, and it looks like it's now filled. So it's not really interesting anymore. So when we talk about filled gaps, and this is what I always tell everyone, when a gap fills, when a gap is created and you have high volume with follow through. So if the gap is down and then price drops with high volume, that gap will take time to fill because that gap has been followed up with institutional trading activity, those big institutional footprints, okay, following through on that gap. So it will take time to recover. And as you can see, it did. It took it took over a year. This is April of 23. This is now. It pretty much filled here, I suppose, which would have been June. I mean, it's more than a year. It doesn't matter. But as you can see, it filled. So what you see here is screaming high volume right there, where the gap took place, right there. Boop. And there was price follow through on that high volume with the gap. Gap's down, price is down, volume's extremely high, trading activity high. That's going to take time to fill. And as you can see, it filled. So there's an interesting lesson there. Nothing you can really take advantage of it at this time, but it is there. So you say to yourself, well, what do you do here? Oh, there's a fly all over me. Sorry about all the waving of the hands. So what do you do here? Derek, what do I do here? Well, you have to have your risk management, cash management, and investment management rules because the fact of the matter is when you see something like this is a great longer term short. Why would this have been such a fun play? What about AT&T would have been great? Well, for one, when you see something like this, you know it's going to take 6 to 12 months to recover. 6 to 12 months, if you can get over 12 months, say into month 13, you now are at long-term capital gains, right? So you're paying tax on long-term capital gains. So as your price was dropping, you could have simply been building into a short. So if you would have said, "Hey, I'm going to go 10% short on AT&T," as price dropped here, you put in 1%, and maybe your rule was, "Hey, every time it drops another 5%, I add a percent." So every time it dropped 5%, you were adding a percent in. Maybe down here you were in 10%. Maybe down here you were only in 5%. But whatever the case was, long, I'm sorry, because you know it's going to recover to this gap. So you're scaling into your long. So you're going 1% here, then it drops 5%. You add 1% to your long. You add 1% to your long. So you're actually scaling in on the way down. And you can have the confidence to scale in on the way down because this is AT&T. This is a huge gap on very large institutional trading. And somewhere right here, when you would have seen right here, this volume right here, when you would have seen this, you would have bought in really, really heavy. There's more sophisticated ways to scale in than what I'm describing to you now. And my one-on-one students are well aware of that fact. However, I would have said right there would have been a huge marker that you would have really dumped in and probably here as well. And why is that? So why these 2 points? Well, it's really simple. I'd love for it to be more complex, but it's not. See this volume? See that trading activity? That signifies institutional trading activity. How do I know that? Because this bar is 1,000% higher than the average trading volume on this chart. And then what about here and here? Well, that's about 1,000% higher than this trading volume as well. Now, how did we know this was buying and not selling? Real simple. See this gap? This gap was created by institutions. See, that's how we know. The gap was created by institutions. Why are there giant gaps created by institutional investors? Because they're trying to instill fear in retail, the less knowledgeable hands, the weaker hands, in order to drive price down to pick up more shares. That is exactly why gaps fill. You see, when I talk about gaps filling and different things, there's mechanics behind all of this. There's reasons that all of this takes place. But the fact of the matter is the emotional response of retail is what will identify when a bottom actually hits, when the correction is actually over, because that allows institutions to buy at cheaper prices, which after all is the goal of these institutions. Okay, so it doesn't look like there's a lot to look at with AT&T. There is a great lesson there, and we just got it. So that's fantastic because you can learn from that. And when you see that again, you go, hey, is that the same type of scenario? And if you're one of my students, we'll go over it and we'll figure it out. Okay, so this is a gappy chart, but it's sort of filling. There's nothing here worth looking at. zoom into a 30-minute. Remember, every time you zoom into a chart, there's a potential opportunity there. Let's see, anything? No. Unfortunately, I don't believe there's anything here meaningful other than that gap is filled. So most likely what you're looking at is down. Yeah. What you're looking at here is most likely down. This gap is now filled. Okay. This is definitely a downward trending stock. So this is down. Yeah. Sadly. Or not sadly. What do I care? That's sadly. Oh, that's funny. Yeah, I mean, look, yeah, I would say this stock is not this does not look good. Uh, yeah, I personally wouldn't want anything to do with it under any circumstance. Especially now. This is uh definitely showing you that I would say institutions are done with this thing. Let's go ahead and say this. This is a great example, though, everyone. This is something, and look, this is what it's about, all right, is understanding how and why this stuff works. That's what my channel and my live streams are all about. We're not going to put a price target on it, although if you're one of my students, you have a very good idea of where that price target is. This is not a sneaky chart, by the way. This is pretty straightforward and pretty darn easy. And what the market does won't have a ton of impact on this particular stock. So I believe we just went over Bank of America. Yeah, I mean, we have just gone over financials. We haven't looked at Goldman Sachs in a long time. We can take a look at that. Let's go on a weekly here. We'll zoom in on Goldman, see what we see. Well, since the breakout of this high, how are we looking? Attempted here. Let's go on to a daily. There's a lack of volume right now for sure. Just trying to see if there's anything that would really interest us. See, this is more purchasing in here. See how it's all this is it's so funny. Most people would say that's selling. This is buying. This is buying. And it rallied up through here. And now volume's drying up. So it's tough to say, do I believe it would come back down into these prices? I mean, traditionally, yes, it would. Mainly because this volume, this trading activity is so darn high down here that you're going to return to these levels and see if there's more supply to pick up, more stock to pick up. Are any like major signals here? No, there's not. I'm going to move on from Goldman. Goldman looks like every other financial right now. JP Morgan. I haven't looked at it in a while. Yeah, see, it looks JP Morgan was, and you can go back to April, I think, May. I was talking about JP Morgan, how healthy they looked. By far the strongest financial. But it's broke out from this high, never returned 170. So if you think that's going to hold, it's not. That will return to that 170 mark. Anything up here? Let's keep zooming in. Whoop. Stretch that back out. Gaps, fills. See, this is fear. Gap down based on fear. You can pick up more shares. That's done. Now it takes off. Same thing here. Far less trading activity at this level. You're approaching a new high on low volume. That's usually not a good thing. Any big signals here, though? No, I don't see any very big. There's nothing here that's huge. Let's go look at Lennar. I haven't looked at these home builders in a long time. Jeez. Whew. That thing's going straight up. Hey, what happens when something starts to go parabolic like that? Anybody? Yeah, this is a breakout, but it returned. This is a breakout return. I will tell you this, it is moving upward in a nice way. I mean, this is it might look parabolic on that monthly, but I'll tell you what, it's returning the previous highs. It's filling its gaps. This is a very clean chart. The buying is taking place at the lower prices in this range, not the higher prices. There's a gap down here, really small, probably insignificant. Another one here that's small, potentially insignificant. What's this big volume here? That's at a high, but that's, yeah, this is a pretty clean chart, everybody. Yeah, there's nothing poking me in the eye here. Where can this thing go? Up. It can go up, and that is where it's going to go. It's going to go up. Look at that thing. And it's healthy. What's that? That's 06. What was it? Right? It was at 70. Now it's at 170. I mean, when you think about it, if it was at 70 at a peak price, I mean, it's not even up 250% in 20 years. That's not outrageous. What else do we have here that we should take a look at? Let's see. Goldman Sachs, Lennar, JP Morgan. We can look at Home Depot, and probably American Express might be fun. Let's look at Home Depot. Wow, who knew? Home Depot. Home Depot is looking a little top heavy there, though. That is the truth. Let's see. Massive trading. There's not like monster trading activity here. Gaps filled, approaching the new high. Gap down here, pretty darn insignificant, though. Look, everybody, like, I am always trying to find things of significance. I am not just simply going to point out areas. I'm not just going to say, oh, this can go here and this can go here. If there's not a major indicator of that, that is a waste of my time and your time. Gaps definitely fill on this chart, which is very good. It's clean. This is a clean chart. See this gap? It came down and filled right here. See this gap? Filled right here. Yeah, it's clean. It's running smooth. It's definitely a stock that that institutions are more than interested in. They're definitely playing here. But I don't think there's a lot of retail manipulation since here. And even here, to be fair, it's not like it's like poking me in the eye and I go, oh, you should have known, run for the hills. Well, let me see. Let me look at a weekly before I say that. Yeah, there's not. This right here it's just a victim of the market. So a lot of times what I'll tell you is trend changes are obvious, and they are, as long as you're looking in the right place, and you need to be looking at indexes. But Home Depot there, it's not, if you were looking at Home Depot and said, how did you see the trend change? Well, you wouldn't. You wouldn't see the trend change in Home Depot. But if you're looking at the S&P 500 and the NASDAQ, and you see that volumes up 500% in December of 2021, December, the holiday, and volumes up 500%, that means there's a trend change in the index, which means we don't trade or invest against the index. You don't fight the trend. And that trend shift was very, very, very easy to see. Okay, American Express, yeah. Business as usual. So for all of you out there that thinks that what Powell is going to say is going to bear some huge significance, it's not. I can tell you right now, I have just gone through, we can look at DR Horton too. I have just gone through the top 10 companies that will be affected by an interest rate shift or decision, and none of them show anything at current levels that is scary or exciting. American Express, I mean, okay, you have a gap up here, and this particular stock looks like it loves to fill gaps. It moves very smoothly. So in the short term, nice gap down on nice volume. Let's zoom in. I like it. So here's a short-term move. Look at that. Look at that bulk. See how thick and bulky that is? It doesn't always need to be a bar that like stretches to the moon. You have a lot of bulk here. And there's not price follow through. This is not price follow through. That means that was a fear move. Well, let's see. Was it? So 250 to what? Yeah, that's nothing. So here you go. We got one. $252. You have, what's today? 21st or 22nd? 22nd. Yeah. For you got 8XP 252. What's today? It's Thursday. 22, 23, 26, 27. We'll give it to the 27. Again, everyone, the reason that there is target dates on here is not for you to try to simply follow along. It's so that you can see that what I do works. I am not one of those guys double talking out there telling you, hey, this works, but it doesn't. That's why I always have an excuse every time I'm wrong. And I make it appear as though I wasn't wrong. I put this up. If I'm wrong, I'm wrong. Feel free to go back and take a look at how often I'm wrong. It is not often. And the reason I show target date. So how can I have that target date, everyone? How's that possible? How do you have a target date like that? Well, it's pretty simple, really. So target dates are based on the chart's time frame. So if you're looking at a one-day chart, for example, based on what season it is of the year, you're looking out 6 to 12 months if you're looking at a daily chart. When you're looking at a 5-minute chart and trading activity is relatively high, you're only looking at a few days. If this was September right now, this is 2 days. A 5-minute chart's 2 days. It's based on, but seasons will have an impact. That is just so you know that. If you're trading in December, if you're trading in July, each time frame on this chart is going to be different than as if it was at a busy time like March, April, May, or September, October, November, right? Those are really busy times. Everyone is active. So you have to be aware of that fact. Is there anyone else? What did I say? DR Horton. Let's take a look real quickly here. See if there's anything cool there. Wow, it's breaking out. There is something cool there. So I have to tell you, I don't know what Powell's going to say. I never care what any of these guys say. The stock market moves that take place after their conversation, after whatever it is that they say, is usually already in the books. It's already occurring. That was all predestined, if you will. They use whatever they say as an excuse for what's going to come. This thing is broken out to a new high from here, which gives it a ton of strength. In the short term, it looks like there will be a pullback. Certainly not a monster, but yeah, it does look like there'll be a pullback. There's follow through, gap. They really gapped it through to higher prices, but there is follow through on price to a degree. However, I would say this thing is going to pull back before it continues its breakout run upwards. This looks to me to be a very strong chart, but yeah, you have this down at 140. They're small. And listen, on individual stocks, you have to take a look at the chart and decide if gaps fill. There's a lot of places on this particular chart that gaps don't fill. So how reliable are they? Yeah, there really is a lot of places that gaps don't fill. Moves down, immediately reverses. This is a great example of back here, everybody, right here. That is an amazing example of a gap created to drive fear, down to the base of the range. Look at the trading activity through the roof, but price immediately reverses, which means this gap fills really fast, and it did. So there's a great example of that. Yeah, there's nothing really here that gets me going. There's a couple concerning areas. I never like this because this is typically when you're gapping up to new high prices, you're looking to generate excitement. And then in that excitement, you sell into it. I would say this is going to reverse before it goes higher. However, when you look at this particular stock as compared to the rest of the market, this thing is reaching new highs right now. So lot of strength, everyone. There's a lot of strength there. I'm going to stop this share here and remind you that what this is all about, everybody, what we're doing here, what the point of all this is not for you to try to copy my target dates or my positions or what I'm putting up here. It's to learn. It's to learn the process. The best way to learn the process, obviously, is to join in on my mentorship or get one-on-one coaching from me. Both very, very reasonable priced, given what you get out of it. So if you're trying to just copy this stuff, you're just in for more pain. It's just going to keep hurting because if you don't have the knowledge behind you to understand why you're doing what you're doing, and you don't have that confidence, right? You don't have the confidence to so you go, oh, that's a good idea. Oh, this seems to work a lot. I'm going to do this. Every time you're supposed to get a knee-jerk emotional reaction, you're going to have a knee-jerk emotional reaction. The way I tell my students, the thing that I point out to them was that from 1990 to 1999, which is one of the great bull markets, maybe not as great as the one we're currently in, but one of the great bull markets in U.S. history. The S&P returned about 11% a year from 1990 to 1999. The average investor, self-directed investor, averaged 1.2%. Why is that? How can that be? How can the S&P 500 have returned 11% per year? The average investor only made 1.2% per year. It's simple. They buy and sell at all the wrong times. Why? Because they get emotionally driven by news, by things that are meant to emotionally drive them. Now, if you build a solid knowledge base, if you have a solid knowledge base that then gives you the confidence to do what you're doing with discipline, you're not going to make those emotional mistakes. I don't care if you've been doing this for 1 year, 6 months, 15 years, 20 years. If you find yourself doing well in bull markets, then every time a market rolls over, you find yourself giving it back or giving most of it back or giving all of it back and then some, you need to sign up for my mentorship. You need to get yourself a solid, first off, a solid knowledge base in what you're doing. You need to build your knowledge, which will build your confidence. You can then build out your investment plan based on cash management, risk management, and investment management. If you don't have a set of rules, very well-defined rules for your investing, you will make mistakes every single time. How much are you putting in? When are you putting it in? What are you looking for? How much risk should you take? How much cash do you need on hand? Which investments are appropriate for you? How much risk is appropriate for you? These are all personal things. All right, that's the end of my preaching. Remember, everybody, if you're not good up here, you're not good anywhere. If you're having a bad day, listen, you're batting 1,000. You've never lost. How do I know you're still here? Get outside, get in the sun, go for a walk, smile, fake it till you make it, right? Fake it till you make it. You can walk around like an idiot for an hour, and trust me, the smile will be real. All right. So listen, everybody, remember, every day above ground is a good day, and I'll